Hello, welcome to It's Your Smarter Money with hosted by Atlas Fiduciary Financial with myself, Dr. Laura, and Professor Steve. We want to talk today about the first quarter of 2023. And, you know, Q1 2023 has proved that the U.S. economy is resilient. We've seen stronger than expected economic data, especially around the labor market. But that doesn't mean there's any concern, right, Steve? I mean,
That's correct. Yep.
first of all, there's the banking crisis that we had, the problems that we had. And despite the government's quick action due to the whole SBP
Yep.
and regional bank defaults, there's still questions around the banking system and what's going to happen. And there's a lot of anxiety around that.
Yeah.
We also know that the banks have been really tightening up the credit market, and we know that that's going to create some problems for the economy.
Yeah, and I just want to mention that this is going to be a bit different from a lot of the videos we've done in that it's going to be more of a freewheeling discussion. We don't really have any kind of canned slides this time, but we're going to talk about various points that we think are important to notice about the economy and also the markets and asset classes so far this year.
Right. So staying on the economy, Steve, since I kind of opened up with that.
No, that's good.
Yeah, the housing market, while under mortgage pressure, still remains viable due to demand, but we don't really know what's going on there. The consumer is not saving as much. The consumer is racking up some debt. And although they're continuing to spend, the question is inflation going to hamper them?
And so I just want to mention about consumer debt. They are racking up some debt, but the average consumer is still pretty decent shape. We go with respect to debt, especially consumer debt. It's still not at as high a level as it was, for example, probably 8 or 9 years ago. So it's still pretty reasonable. Of course, though, the issue is with high inflation, people's costs are going up, and there could be people that are putting ordinary expenses on a credit card. So we could see that start to spike. And that is certainly a concern. And some things I've read anecdotally in the Wall Street Journal and other places are that some people are having trouble affording things and that they are using debt to actually pay for current living costs. And that's somewhat disturbing.
Right. You know what else is disturbing also? Because of the banking crisis. Well, this actually started before even 2023. It started in 2022. The banks started really tightening up their lending practices, and a lot of small businesses are not able to get any kind of funding, and that's going to have an impact on the overall economic growth of small businesses.
And there have been issues too related to capital, companies acquiring capital, for example, to drill wells and other things, because it's been a policy to try to inhibit that activity, and that's made it harder on some of the companies. Which has also led to increases in energy prices as well. So,
right. So the economy is a little bit in shaky ground. Although we did not necessarily see an official recession in the first quarter, that does not mean that we are not necessarily going to hit a recession this year. There is a potential for that. We're not sure how difficult it's going to be, but some of you may recall we did a presentation a couple of months back where we talked about how the economy and the markets are actually two separate things, that oftentimes we'll see a decline in the market before we actually see the impact in the economy. And so it does not necessarily mean in itself that the U.S. stock market is not going to be successful or do well or have growth in 2023. And we saw already in this first quarter that the S&P 500 did quite well.
It did. And which is an important point, because the market's still really not cheaply valued. I think the price to earnings ratio is still close to about 17, which is not exactly cheap. And I think that's based on forward earnings. And
rear looking earnings are still a lot high. It's a lot higher.
That's correct.
And the interesting thing, Steve, about this first quarter is that the S&P was up by 7.5%, but it was driven a lot by the growth stocks.
That's right.
We did not necessarily anticipate. After last year, the growth did not do well. And while growth stocks have come down in value and their price to earnings ratio isn't as much out of line as it was last year, it's still overly valued. They still don't look attractive at all.
Well, I had the price to earnings ratios here. And right now, for growth, it's around 23.8. For value, it's around 14 to 1. And also for the blend, which could be the S&P 500, it's around 17.8. And so, that's pretty high for growth. And the 20-year average is 18, and it's at 23.8. So the market's not really cheap right now. So, and of course, there is and I've seen some evidence that corporate earnings could be slowing as well, which means that forward earnings may have been overestimated.
Well, with technology, the one thing that they can do, some of these growth companies, because they don't have necessarily as much fixed assets, tangible assets, and so forth, is that they can cut back on their labor and they can engineer those earnings. So they may be able to maintain a higher level of earning for a while, even though the top line isn't growing so much. They can maintain that, although there's going to be ramifications if they do that too much, right? For their growth.
Yeah, and that's the employment's been strong, but that's one area where we've seen some weaknesses at some of the tech companies. They've been laying off people. Some of them have. I know. I believe Facebook and some of the others have laid off people. We know Twitter did when Elon Musk took over. So there's been weakness in that area.
Right.
So.
Right, and so value continues to look more attractive. Based upon the valuations. And not only that, we know that in high inflationary, anything above 4%, 4 to 8%, we know that value tends to outperform growth.
Yes.
So we still have that value tilt in all of our clients' portfolios.
And in particular, high cash flow companies. Some of our holdings are among the top 100 companies in terms of cash flow in relation to not their book value, but their enterprise value, which is a combination of their book value, but also intangible assets that don't appear on the book, on their books as assets.
Right. Although, in the first quarter, value did not perform as well as growth. And so we saw that in terms of our performance was a little bit dampened down by the actual U.S. stock market holdings in large cap. But what we did see do well was the international sector. For finally, the international asset, especially developed countries, is the top performing asset class for the first quarter.
Yeah, and some of our holdings up between 7 to 9% in that asset class. It's been our best asset class for the year, actually. And the second best, surprisingly, our reinsurance bonds up over almost 5.5%, which is a phenomenal return so far.
So we have the international asset classes being one of the top performing asset classes. And then we have a bunch of other alternative, call them alternative to traditional asset classes, or what we like to call enhancer asset classes, also did well. Reinsurance did very, very well. Even convertible bonds did very well.
That's correct. They're doing pretty well. And I was going to mention here, what's interesting is that international is actually valued very fairly. The other thing, by the way, it's affecting international right now is the weakening of the U.S. dollar. It's been weakening of late. And so what that means is it means that international investments tend to perform better. And right now, international is the price to earnings ratio is about 12 versus, I said, somewhat over 17 for the U.S. And that's a big difference. And international, at least the developed markets, which we lean toward, their current price to earnings ratio is below the 15-year average. And now we've seen an era in which the S&P outperformed international investments for, I think, 13 years or so. And that is the longest period ever, at least in the data that I've seen, in which domestic outperformed international. So it's a strong argument that performance may cycle back to international versus domestic.
So we had a feeling that was going to take place, and it appears that it has. And the alternative asset classes that we have, those enhanced asset classes, also seems very well positioned to help us through the cycle as we continue to move forward over the year. But we'll keep an eye on that.
Yeah, our long short funds are up about 5% or so,
Yeah.
which is pretty significant. And I just want to mention, I knew you would have, but I will mention once again, it shows the importance of asset allocation and not trying to time markets and try to sit down and try to figure out which market's going to be the next winner. Very hard. It's very, very hard. And this proves.
Absolutely. Each of these asset classes has a cycle and their ups and downs. And what was top performing last cycle is now not the top performing. Matter of fact, one of the worst asset classes so far year to date is commodities, which we know was the super
Yes.
last year.
Yeah.
And depending upon what happens with OPEC, we'll see what happens there.
Yeah.
There are some cutbacks that have been announced with OPEC, which potentially could impact the commodities market, as well as with China reopening. I also would anticipate some demand on raw materials and commodities, and so that also should potentially favorably impact it, but it hasn't yet. And so this is why we continue to keep this asset allocation strategy where we're in all different kinds of asset classes in a hyper diversification. So each one has a different source of risk, and we can maintain this ongoing maintenance of your portfolio so that we can experience some growth and stay ahead of inflation, stay ahead of taxes. The one thing that we continue to ask all of you, especially if you haven't spoken to us recently, is that you please talk to us about your cash obligations. As long as we're not required to sell into any declining market, you're going to be fine because you are in investment grade quality investments. So that's really the big thing, is making sure that we're mirroring your spending needs.
Yeah, and the bond or the fixed income part of your portfolio, we always only buy the safest bonds. And I just saw some data, for example, in municipal bonds, AAA, the default rate over the last 10 years has pretty much been zero. Even for, I think A was around, a 0.1%, very, very tiny default rate. And that's why we stick to the highest rated municipals and, CDs and treasuries. We've been buying treasuries of late because the yields have been good for the first time in probably about 10 years. And so we only buy the safest fixed income, and generally we hold the maturity, usually. So we shouldn't have any issues with our fixed income at all, as opposed to funds. A lot of the mutual funds, especially the Vanguard ETF BND was down about 16% or so last year. Our fixed income held up well.
So for 2023 Q1, so far so good, but that we're remaining vigilant. And with the looming economic concerns, we continue that value tilt. We continue to remain hyper diversified, looking into other sources of risk, and we maintain our strategies around maintaining a low risk and having your cash available for you. Please let us know if you have any concerns or you have any needs that we have not been told about, so that we can mirror your needs. Thank you again for listening to us, and we'll see you again soon.